Managing working capital is not about spreadsheets alone. It is about survival. Every business runs on a simple rhythm, often called the cash-to-cash cycle. This cycle measures how long it takes to buy raw materials, convert them into finished goods, sell them, and collect the cash. Imagine you pay suppliers today, hold inventory for 30 days, sell the product in another 20 days, and then customers pay you after 30 days. Your cash is locked up for 80 days. That means you must fund almost 3 months of operations before you see your money again. The shorter this cycle, the stronger your business becomes. If you can reduce inventory days from 30 to 20 and collect receivables in 20 days instead of 30, you shorten the cycle dramatically. Even a 10-day improvement can free thousands of dollars in cash. Working capital management starts by understanding this operating cycle clearly, because time literally equals money in business finance. Inventory management plays a major role in controlling working capital because inventory is essentially cash sitting on shelves. If you carry too much stock, you create what many finance professionals call dead capital. That money is locked inside products that are not generating immediate returns. On the other hand, if you carry too little inventory, you risk stockouts, lost sales, and disappointed customers who may never return. The objective is balance. For example, assume your business generates $70,000 in monthly sales and your cost of goods sold is $42,000. If you are holding $120,000 in inventory, that equals nearly 3 months of stock. Unless your demand is extremely stable, this is inefficient. Instead, study your sales data carefully. Identify fast-moving items that sell consistently and maintain optimal reorder levels for them. For slower-moving products, review performance every 30 to 60 days. If something has not sold in 90 days, consider discounting it or bundling it to recover cash. Monitoring your inventory turnover ratio regularly helps you see whether products are moving at a healthy pace. The faster your inventory turns, the less cash you need to keep the business running. Smart inventory optimization protects liquidity while still supporting steady sales growth. Accounts receivable management is where many profitable businesses quietly struggle. Revenue on paper does not pay bills, only collected cash does. If you allow customers to take too long to pay, your working capital gets stretched even though sales look strong. The first step is setting clear credit policies. Define your payment terms upfront, such as net 30, and make sure those terms are visible on every invoice and agreement. Do not assume customers will automatically pay on time. You must create structure. For example, if your monthly credit sales are $100,000 and your average collection period drifts from 30 days to 45 days, that extra 15 days means roughly $50,000 more stuck in receivables at any given time. That is significant liquidity pressure. You can encourage faster payments by offering early payment incentives, such as 2% discount if paid within 10 days. While you give up a small portion of margin, you improve cash flow stability, which often matters more. Also, establish credit limits based on customer history. A long-term client with a strong payment record can qualify for higher limits, while new or inconsistent customers should start with tighter controls. Implement a disciplined follow-up system. Send reminders a few days before due dates, follow up immediately after invoices become overdue, and escalate professionally if delays continue. Track your average receivable days every month. Even reducing collection time by 10 days can free substantial working capital. Strong receivable management reduces dependence on borrowing and strengthens financial flexibility. Cash collected faster means more control, less stress, and a healthier balance sheet overall. Accounts payable should be managed just as carefully as receivables, because timing your outgoing cash is just as important as speeding up incoming cash. Many business owners pay suppliers immediately out of habit, but that is not always the smartest move. If your supplier offers net 30 terms, that means you legally have 30 days before payment is due. Using those full 30 days allows you to preserve liquidity without harming trust. In some cases, you may even negotiate net 45 or net 60, especially if you have a strong payment history and consistent order volume. For example, if your monthly purchases are $60,000, extending terms by 15 days can significantly ease short-term cash pressure. However, discipline is critical. Never miss agreed deadlines, because damaging supplier relationships or credit reputation can create bigger problems than temporary cash strain. At the same time, build a rolling cash flow forecast covering at least 3 to 6 months. List expected inflows from customer payments and expected outflows such as payroll, rent, loan installments, taxes, and supplier payments. This forecast helps you identify potential shortfalls early. If you notice a projected gap 2 months ahead, you can prepare backup solutions like a bank overdraft, trade credit, or invoice factoring before the situation becomes urgent. Managing payables strategically is not about delaying irresponsibly. It is about aligning payment timing with your overall operating cycle so your working capital remains stable and predictable. One of the biggest misunderstandings in business finance is confusing profitability with liquidity. A company can report strong profits and still collapse because it runs out of cash. Profit is an accounting result, but liquidity is the ability to pay bills today. If you cannot cover payroll, rent, taxes, or supplier payments on time, profitability will not save you. That is why monitoring key financial ratios is essential. The current ratio, calculated as current assets divided by current liabilities, should ideally stay around 2 to 1. This means you have $2 of short-term assets for every $1 of short-term obligations. The quick ratio goes further by removing inventory from the calculation, showing how much near cash you truly have available. You also need to avoid overtrading. Rapid growth sounds exciting, but expanding too fast without enough working capital can create serious stress. For example, doubling sales may require doubling inventory and offering more customer credit. Without sufficient liquidity, growth can drain cash quickly. Sustainable expansion requires financial strength behind it. Managing working capital properly ensures your business remains stable, flexible, and capable of growing without risking survival. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.